said that's good. Said that's a word while we're we can name this for.
All right, I think we're live. All right, we're going to be digging into cost segregation analysis and analyzing some beach properties. And then this is the Kind Hotel Hub. Joel Farrell here, your host. I've got an amazing guest on today with us, Jeff Badu, and somebody that I've known for a number of years, serial entrepreneur, author, radio host, and also entrepreneur and owner of the Badu Tax Strategy Services. But Jeff, thanks for making time for us today.
Yeah, thank you for inviting me, Joe. Definitely appreciate the opportunity. Yes, indeed.
So you and I, we're in the game of real estate. You've got a portfolio of stuff that you're doing in Southwest Chicago. Cost segregation for me personally was what I call the holy grail of real estate investing. Getting to this point, which I never even dreamed of, didn't know about until, coming across it from some of our conversations in the past. How would you describe this type of tax strategy as we're going to be digging into some of the details? How would you describe this for somebody that has a vision of building a real estate portfolio for the long term?
Yeah, definitely. Definitely appreciate that, Joe. So basically, cost segregation in simplistic format. Myself, I like to keep things very, very simple. And so basically, the way that I would describe cost segregation is the ability to gain a tax deduction for the accelerated or increased depreciation on a rental property. So typically when you have a rental property, let's say a residential rental property, you would take a tax deduction of basically the purchase price, and usually you subtract out the land, divided by 27.5 years. And that usually gets you your annual depreciation deduction amount. And depreciation is an expense of the property, basically, of the purchase price of the property that you can claim each year. That helps offset the income and expenses of the property, or the profit of the property, at least on paper. And depending on what you are, depending on your status, you can actually get what we call basically a tax deduction against your other source of income. If you're known as what we call a real estate professional. But basically, cost segregation allows you to accelerate that depreciation by taking the purchase price, and we use an acceleration rate. And typically for 2024, right, we're looking at anywhere between 10 to 15%. So in a nutshell, if you have $1 million property and you do a cost segregation analysis or study on it, then you should expect a tax deduction of at least $150,000 that can help offset other sources of income, such as W-2 income, essentially.
Okay, so I want to back up a little bit. So if you're not a real estate investor or the real estate classification to do cost segregation, what are the limits that are applied in terms of allowing depreciation deductions?
Yeah, so I'll just keep it simple, right? I'm a big proponent of keeping things simple. So basically, in terms of if you have a beach property, let's say Airbnb, right? Let's just call it Airbnb property, then basically you're sort of always going to be eligible for the deduction, because at that point it's considered an active investment, an active property. And so when you have an Airbnb, a beach property, basically what you're allowed to do is claim it as active. And when you claim it as active, that allows you to utilize the depreciation in full without needing to be like a typical real estate investor, somebody who does 750 or more hours in real estate throughout the year, called a real estate agent, real estate investor, contractor, flipper, right? Owner operator, right? So basically, you don't have to meet those qualifications in this scenario, if you have a beach property like an Airbnb property, essentially.
Okay, so the allowable opportunities, if you're a real estate agent and have your license, allows you to be able to capitalize on this. If you spend 750 hours, so what's the math on that per day? 2 hours a day, something like that?
Yeah, so I mean, if we take, let's just pull out a calculator here. right? We do 750 divided by 365 days a year. That's 2 hours a day, exactly. So literally just spending 2 hours a day. Of course, some people don't work weekends. So give or take 2 to 3 hours a day. Um, yeah, that's pretty much all you're doing in real estate throughout the year,
Okay.
basically.
Okay. So for the proper channels to be able to document that, what's one tip of advice that you would give to somebody? And this applies for long-term rental type of stuff.
Correct.
How do people document that?
It's as easy as a spreadsheet, just an Excel spreadsheet tracking the date, basically the date, right? You want to put the date that you did the activity. Basically, what did you do for the activity? Maybe you went out to look at real estate, for example, which would count. You did some bookkeeping on your real estate. You met with your property management team, right? So pretty much anything. You went out to, meet with your lender to talk about real estate, talk about the deal, do some analysis. So basically, I usually recommend an Excel log, like a spreadsheet that has the date, and then pretty much the activity, right? What did you do? It can be very basic, just a few words, few sentences, and then how much time you spent. Right? So you spent an hour, you spent 2 hours, and yeah, that's it. That's it.
Okay, so I want to back up. So let's say that I've got $1 million of real estate
Mhm.
across a couple properties. And if I don't use this tax strategy, we're accelerating the depreciation. Then if I'm right on this, so 27 and a half years, spread that over time. So in that first year, you're gonna have a limited amount of depreciation that you can collect or expense on that first year, right?
Yes, sir. Right.
Okay, so in this strategy, you can accelerate that in the first couple of years, or what's the cadence of how the strategy works?
Yeah, it's basically 1 year. It's a 1 year acceleration. So put it in very simple terms. Take the purchase price, multiply by 15%, and that can get you a reasonable amount of how much you can claim as depreciation expense. Accelerated depreciation, assuming you went through the proper channels of doing a cost segregation study with an actual professional cost segregation team.
Yeah, because
For 1 year.
we have one question from the crowd here. So the
Absolutely.
that 15%, that's just for the first year, right?
Correct. The 15% would be for first year. So 2024, for example, you bought the property. And it's based on the date you placed the property in service, meaning when you started renting it out to other people. So you could have bought a property 100 years ago and you just started renting it out today, then you would apply 2024 rules to that. And so basically, with that being said, what we would do is take the purchase price multiplied by 15%. That's your year one acceleration rate. So $1 million times 15%, 150,000. You take the remaining 850,000 and you spread it out over the next 26 and a half years because it's typically 27 and a half years. So you would take away a year from that.
Okay, before we dig into some of these examples, because we're sitting here at the Sobal House in Rosemary Beach at a podcast Swiss Army knife area, and this overlooks this corridor. And down the way here, you've got some homes that are $19 million, $16 million, $8 million. So this is a unique area of the Emerald Coast and the Panhandle of Florida, in between Destin and Panama City on 30A. And the people that are buying properties in this area, you're talking about the average, somewhere in the 1.5 to $3 million range, depending on the specific, city. Seaside, Rosemary, Watersound, Alice Beach, Sea Grove. There's 13 to 14 different communities here. So we're going to dig into two properties. One is a single family house, one's a condo in the $5 million range. And these are both going to be, with water views. So we're going to take some real examples of some listings in the market. So bonus depreciation and the trend. So the bonus depreciation has been phased out over time. So what are the numbers been look like in the last couple of years for investors?
Yeah, that's a great question. So basically, in terms of bonus depreciation, so it all really, I mean, this has been around for a very long time, but it really got it really got amped up when Trump got into office. So back in 2017, they signed the Tax Cuts and Jobs Act by the Trump administration. And that now allows us to claim bonus depreciation on rental properties, right? Never really before could you do a full year bonus accelerated depreciation on a rental property where you can claim the full benefit in 1 year, basically. You had to spread it out over 5 years, 7 years, 15 years, depending on what the specific item was. And so basically in 2017, they said, hey, if you place a property in service, let's call it, in Q4 2017 and after, then you're basically able to claim bonus depreciation on rentals, right? So between let's call it Q4 2017 and 2022, you were able to do 100%. So basically what that means is that in that $1 million property example, it would have been 25%, right? 25%. And so a $250,000 tax deduction on $1 million property, if you place it in service between Q4 2017 and 2022. And in 2023, the year that we're filing taxes for now, the rate basically dropped to, let's call it basically 20%, right? So 20%. And so now we're looking at about a 20% acceleration rate for 2023, right? So if you bought a rental property 2023, or you place it in service in 2023, remember, it's always based on when you place it in service. When did you get tenants? When did you start claiming it on your tax returns, right? So basically the acceleration rate has gone down by a 5 percentage point each year. So 2022, 25%, 2023, 20%, 2024, 15%. And this is assuming you're doing a full-blown cost segregation study, right? There are some folks that may sort of do their own study. Maybe they don't use a professional or a CPA firm or anything like that. So they may get lower rates because they're not doing a full blown where a team goes out, looks at the property, looks at the components, cabinets, flooring, roof, all that stuff. So basically it's scaled down by pretty much 5%. So 25%, 20%. 15%. So right now we're looking at 15%. Now here's the thing, right? This is not a political stance or anything like that. But if Trump gets back in office, which appears to be most likely to happen, right, during the elections this year in November or so, then what will most likely happen is he's going to renew everything. And so we'll be back up to the 25% instead of the 15% that we are currently.
So if something happens the opposite direction and we're at 15% now and the status quo stays, what happens in 25?
25 would be 10%.
Okay, so we're stepping down
after,
to 5 and then 0.
Exactly, but after 25 though, it expires completely.
Okay.
And so somebody's got to do something about it next year.
Okay. We do have a question in the audience.
Yeah, so just to clarify, so in addition to the cost segregation for year number 1, does that get accompanied with the bonus depreciation? So are you saying that you get 15% for year 1 and you can add another 15% for 2024, assuming that we're under the same, and so that would be a 30% first year?
Yeah. So Jeff, I'm not sure if you heard that. So that the 15% for 23, that is the bonus depreciation that we're talking about, right?
Correct.
Was it 15
exactly.
on top of 15?
So technically speaking, you can go up to 20%. So 2023, it's up to 20%. So it's a one-time, one amount, 20% flat out all in.
Okay. And I'm sorry, we're in 24 already. Okay. So 24, it's 15%. Okay. And that's part of the reason why I think it's so important to be talking about these things, because in this environment, and we're going to be having a panel talking about the state of real estate in this area of the Emerald Coast. And, housing crash has been a big topic in the media and in pundits and data, and prices have gone up so much in the last 10, 15 years from the last crash, and rates are high right now. And the inventory is tight. Transactions are pretty much at all-time lows compared to where we were, since the early 90s. And so the crash isn't happening in prices, it's happening in the lack of activity, which is affecting a lot of other industries that are tied to the real estate space, whether it be contractors or title companies or lenders or agents and all the other things that go into Home Depot. All these things are tied to the housing industry, and the lack of transactions is having an effect. And so prices are high, rates are high, and inflation is coming down to, close to the Fed's target of 2%. And if we get closer to those targets and the Fed does pull off the gas on where rates are, maybe starts to bring them down, which has been a big topic and expectation of bringing the Fed funds rate down later this year. If that happens, I think we'd all agree that the consensus is that prices of homes are probably going to continue to go up with so much pent up demand and cash on the sidelines waiting. And in my personal journey, talking to home buyers every day, there's a lot of people who are qualified and able to purchase, but are hesitant because they're scared of what's going to happen with the markets. If I put my $25,000 that I just saved up for 5 years to buy my first house, I don't want to buy a house and then have the market crumble and lose everything. And so the confidence in the markets, I think, is the biggest piece of the puzzle that I'm seeing is holding a lot of things up in terms of activity. So on the flip side, I'm in Florida, and those that don't know my personal journey, it's been a 15-year process to get to having a property on the beach that I purchased in 21, and stair-stepping my way up and building and building and building and scaling and letting time do its thing. I couldn't have got there without the little bit of things you do in the very beginning of the process. And, working in sales, I work in the mortgage industry. I'm in a commission job. Not everyone's built for it, but the more you work, the better you are at your job, the more you can make money and have the potential to be able to save money, stockpile money, and then be able to invest in assets, whether it be stocks, bonds, real estate, crypto, et cetera. And in an inflationary environment, holding cash is going to be hurtful. Holding assets can help you protect yourself. And so the people that are earning high incomes have an opportunity right now in this stale market to maybe find some deals, but also be able to use real estate as a tool to be able to propel their wealth journey, having assets grow, have cash flow, have appreciation, but also the tax side of things. So you use the $1 million scenario and said $150,000 of reduction in taxable income. So let's say I've got an entrepreneur and they have a great year in whatever business they have, and they make taxable income of $500,000. Can you walk us through, we're going to be building up to this kind of $5 million scenario. So this ultra kind of high level earner, but in this scenario, $500,000 of income. And let's say they have $150,000 tax deduction. Walk us through kind of the math and logic.
Yeah. So what kind of purchase price are we looking for in terms of the property?
Well, let's just say they already own $1 million portfolio.
Okay.
And this is the first year they're going to have it in place for this tax strategy. So the 15%, I guess, would apply for. No, I'm sorry. Yeah. 15%. So they're buying $1 million property this year.
Sure.
So using this year's laws.
Yeah, definitely. So let's just assume, right, you got a $500,000 earner who is looking to buy, a $1 million beach house, right? And typically in this scenario, they're probably going to utilize it as a vacation home. However, they know basically Airbnb is booming, at least in some markets, and I know Florida is definitely pretty high. And so with that being said, they buy a $1 million rental property listed on Airbnb. They get some tenants, they're doing some self-management. Maybe they get help with cleaners and everything like that too. But overall, in a nutshell, let's say they're $500,000 taxable income, and assuming this is a married couple, right? Let's say this is a married couple making $500,000. Then you're looking at a tax rate effectively, or basically a marginal tax rate of just around, about 35%. So if that client were not to do anything and they just had 500,000 in taxable income, 500,000 times 0.35, that's $175,000 in taxes that they would pay if they were to not invest, right, not to utilize a strategy. However, that $1 million property, right, we can do the cost segregation study, bring in the engineering team, and we get $1 million times 0.15, so 15% as a tax write-off. So all of a sudden, their taxable income goes down by 150,000. So now we have 500,000 minus 150,000, which is 350,000. So instead of being taxed on 500,000, now they're being taxed on 350,000. And effectively, now that pushes them to, excuse me, now that pushes them to a lower tax bracket, namely, let's call it a 24% bracket. Now, the way taxes work, it's not exactly one for one, right? Just because you move into a lower tax bracket doesn't mean you'll pay that exact rate, because it's basically a marginal rate, right? It's based on the next dollar. It's not based on the next bracket. But let's just, in simplicity, let's just do a 24% bracket now. So 350,000 times 24%. Now we're looking at $84,000 that is being paid instead of 175,000. So we take 175,000 minus 84,000. That client literally put back an extra $91,000 in their bank account by doing a cost segregation study on $1 million rental property.
Okay. So if they do a regular depreciation and not this accelerated process, to use very simple math and not to be exact, would I just take $1 million divided by 27 and a half, and that would be maybe the first year amount if they did the opposite strategy?
It's safe to do that. We would have to knock off some land, right?
Yeah.
So we would have to knock off anywhere between 10 and 20%. But to keep it simple, that's technically what you just said would be correct.
Okay. So that number is going to be obviously a lot smaller. Okay. We do have a quick question from the audience.
Is there a limit to the amount of real estate that you can use that first year? So what if it was a $5 million property?
Yeah. So let's save that for this
Okay.
next scenario, because there's more that we're going to be able to dig into
Okay.
in terms of the long-term strategies
Yep.
of how it all continues.
Absolutely.
So, okay. Let's jump into this example. I'm going to go ahead and just share my screen. And
by the way, real quick, Joe, that was the $1 billion question of the day. So I don't know if you have a reward for that individual, but that's the $1 billion question of the day.
All right. Thanks, Sean, for the question. So what kind of award are we giving? How much money? Some brownies? Brownie points?
A beach.
A beachfront property.
I'll just take a condo.
Okay. $1 million, no big deal.
Would be nice. Would be nice. Man, oh man. Yes, sir.
So I'm going to share the screen here. Okay. Can we all see this listing on Redfin? 8334 East County Highway, Unit 6. So this is a condo. Oh, this is not the right one. Well, it's fine. There's another one that was listed for $5 million, similar to this, with water views. So let's just use this for $5 million. So we got a beach property, $5 million. Let's do the math on that real quick, Jeff. So 15% of, say, 5 million.
750,000.
Okay. So 750,000. So then if I take this property, which is a condo, versus a $5 million house that's listed at the same price, where you're gonna have more land with a house versus the condo, for the cost segregation analysis and that bonus depreciation, does that matter or not matter?
Yes, it does matter. I mean, ultimately the deduction. So we're gonna end up at a slightly different number, right? It's not gonna be exactly right. For example, the 15%, give or take, it might be 16, it might be 14, but that tends to be the sweet spot of where I like to look at. Here's the big asterisk: if we are utilizing a professional cost segregation engineering team. That's the big asterisk I want to put next to it, because some people can try to do this on their own, but they may get 10% instead of 15%. And the report, right? This engineering team is going to send you a nice report that you can use as proof of you doing a study that you can send to the IRS in the extremely unlikely and unfortunate event of an audit. So basically, what we're looking at is I still apply the 15% no matter what. And I do want to answer at the appropriate time. I do want to answer that individual's question regarding what's the limit, because that is the $1 billion question of the day. What is the limit? Like, how much of this good stuff can I get each and every year? And there is unfortunately a limit, but it's not a bad thing. It's just limited based
Okay.
on that specific tax.
Okay, I'm just been sharing some pictures of a listing of a house, 109 Kaya Avenue in Inlet Beach. Okay,
It's
so
beautiful, beautiful
this
house.
example, 500K of income from the business or a W-2, and now we've got a $5 million property, and we did the math on that. We said it was 15% would be 750K for
Yes, sir.
deduction. Okay, so then what?
Yeah, so I mean, so basically, so yeah, this would be a property that we can get a $750,000 tax deduction, give or take, right? If we do the cost seg, assuming this is an Airbnb property, you know. So to answer that question, there is a limit where for a married couple, we can only claim up to $610,000 of excess losses. So of that 750,000, we would only be able to claim up to 610,000 in year one, and that is known as a net business loss deduction limit. And unfortunately, not all, basically with the Trump administration, one of the other things that they implemented was this rule. I don't know exactly why, because in theory, it doesn't really make any sense. Because you think about the Trump administration, the business people, business minded, but next thing you know, they put into place this limit, this rule. And this affects folks, like NBA players, athletes, right? These folks get hit hard when it comes to this because they're high income earners, they're earning, millions of dollars a year. So they're not able to fully leverage these things. But basically, of that 750,000, 610,000 would be able to be claimed to offset other source of income. And then the remaining 140,000 would carry over to 2025 to offset 2025 income, or taxable income, assuming there's enough, right, taxable income to offset with that 140,000. And so with that property, if we're looking at that example, we'll be able to claim a tax deduction of 610,000 for a married couple.
Okay, so if that person is making 500,000 of income, that's going to bring their taxable income to effectively zero.
Exactly.
And
I mean, assuming I could imagine that. I mean, they could probably, but I could imagine a lender may not approve, somebody for a property like this. They could, right? They could not, just depends. But yeah, if you're buying a 750, if you're buying a $5 million property with $500,000 in income, assuming you can afford it, you can pay the mortgage, then technically speaking, in that year, if you're a married couple, you just wiped out your whole tax bill. And now you can use that money, that 175,000 or so that you saved in taxes, and guess what? You can buy another property and do the same thing next year.
Okay.
And assuming that if Trump got in or somebody was in and it was 25%, then the 25% would be the
potentially come back in again. Yeah.
Exactly. So it'd be 5 million times 25%, a full 1.25 million. Tax
out of 610 and you carry over.
Yeah.
Exactly.
So let's say I've got somebody who, it's a life event and they're buying a, $100 million, $25 million portfolio of apartment complexes, et cetera. And now they do this type of strategy. We're talking millions of dollars of depreciation that could be potentially be accessed. There's a limit of 610,000 in 1 year. Does this stuff just carry on for years?
It carries on until death.
Okay.
And upon death, the depreciation restarts upon death. So it goes on forever until 1,000+ generations that come after that person.
Okay. I want to just back up one step. So let's go back to that scenario of $1 million. We did the math at 15%, and now we're using 150K, right? So that number, we're not going to exceeding limits. But then on the scenario of the 5 million, now we're exceeding the limits, right? So we're capped at 610. We got some carryover. If I have
Okay.
other expenses with the property, like taxes and insurance and all the other
Mhm.
things that come with real estate investing and the expenses that you can claim, am I able to take that 610 depreciation and then also still be able to claim these other expenses on top of that? Or am I capped at 610 altogether with everything?
That's a great question, Joe. So you're capped at that amount, but here's the thing. Even if you're making all this money with Airbnb, right, you're going to be offsetting that with expenses, mortgage interest, property taxes, utilities, repairs and maintenance, some closing costs, right? So naturally, on paper, real estate, what I've seen with our clients or just clients in general, they're showing a net loss on paper on the real estate all the time, right? Probably 90% plus of the time. So all those expenses would have offset the income that they're making on Airbnb anyway. And then we throw in this extra depreciation, which is capped at all expenses, all in, other businesses, everything like that at the 610.
Okay.
Now, if somebody has the $1 trillion question of the day of how do we get past the 610, we can certainly answer that question as well.
Okay. Before we get there, we got one question in the chat. And if anybody's out there that has any questions, definitely throw them in the chat. By the way, if you're watching this, live stream, we're at 133 from across the world watching this. So that's pretty cool. Thanks all for watching. And so any questions, throw them in the chat. So William Champion says, how many properties can I do at one time?
There's no limit to how many properties. The only limit is the 610. And if I can imagine somebody has a question out there, hey, what if I'm a single individual and I'm unmarried? Then it's 305,000 is your limit. So one of the best tax strategies in the world is to get married. So just just putting that out there.
All right. Okay. So I feel like if you said $1 trillion question, that's a big deal. I have to bring this up because I had fun. I interviewed you, I think, at the end of 2022, early on the Strive for 25 podcast, and we went through a hypothetical example of cost segregation for a real estate agent who has their license, and they say go buy a quadplex. I guess at the time we used an example of 400,000 because we were using the 25% number. So then that would have been 100K off of their income. So that brought their taxable income from 150 to 100K. And in that example, we talked about, well, then save the money and then buy the next one and then the next one. And you threw out a B word that I did not expect you to throw out there, but I got excited when I heard it. Anybody know the B word that I'm about to say?
Not bitch.
Not that B word. Anybody else have a guess for which B word I'm talking about? I'm using the word trillion. Which B word am I talking about? Billion. You use the word billion in this conversation, talking about what's possible. And, having a chance to talk to Kyle today, Kyle Miller, and then so far Blake Jones, and we have Rachel Waller next. Hearing their stories about their journeys in scaling into real estate and, building homes and all these things. When you start talking about time and putting work into, Blake talking about 100 hours a week, building that business, time gives you the opportunity for appreciation and principal pay down and cash flow and tax benefits to be able to then continue to scale. This is a long game. When we talk 10, 20, 30 years, B word comes into play if you follow the blueprint. So that I had to say it out loud because these words are possible if you have, the long-term vision in mind. So back to the T word, which I did not expect the T word to come into play here. So what the hell, what are you talking about here? What's this T word question that gets you past this 610 limit?
So I'll just say this. Unfortunately, if you're looking to become a trillionaire, W-2 income won't get you there. Right? If you're looking to become a billionaire, W-2 income can get you there. But if you're looking to become a trillionaire, W-2 income won't get you there. Why? Because of taxes, caps, right? When it comes to certain things. So to get rid of the cap, we got to get rid of the W-2 income. We instead get maybe 1099 income, right? We start our own business, franchise, or partnership, whatever the case may be. And we would set up basically through trust, right? We would set up trust funds here. And full disclosure, this is how Jeff Bezos, Elon Musk, Warren Buffett, and the greats, this is how they have their thing set up, where they receive all their income through a business trust, right? All their income, all their businesses and everything like that gets paid through a business trust. And in that business trust, there's basically no limit on how much cost segregation they can do. So all that income can get all offsetted by properties, cost segregation. You know, as you know, we all may know by now, Warren Buffett, the greatest investor of all time, owns a real estate company, right? Part of Berkshire Hathaway. And so basically with that, the way he can have it set up is all the money that he's making in Berkshire Hathaway. Of course, Berkshire is a corporation, so he probably has his own thing set up. But we all know these companies, these billionaires, they live through the corporation. Elon Musk, his private jet is paid by Tesla, right? Jeff Bezos, his private jet, right? Amazon, right? Things of that nature. So basically, you can have all your income, all the money in the world. Let's say you are a real estate agent. And I mean, you got teams across the whole world. You got hundreds of people on your team. And you're making so much money, you don't know what to do with it. Well, put your money where your mouth is. Buy real estate, the thing that you're promoting the most. So you buy a bunch of real estate each year. You do a cost seg on each one. You can wipe out your tax bill to zero every year. And get this, your primary residence, your property, you would set up a family trust for, and you would have the business trust pay into the family trust and get a tax deduction for that. So your house can be paid for. You know, your cars, you probably put that in the business, right? But your home, things that are more personal by nature, like your personal residence, that can be paid for by the family trust. Medical bills, you want to send some money to family, right? Kids, college education, and all of that, we pay those through the family trust. And then what's left over, if anything, you put that through a family foundation trust, which allows you to basically donate up to 60% of your income into that. And you may have heard that folks like Mark Zuckerberg, right? Facebook is basically, his stock in Facebook is not owned by Mark Zuckerberg. It's owned by the Mark Zuckerberg Foundation, right? He basically donated 99% of his wealth to his foundation. People are like, man, why in the world would he do such a thing? It is because he doesn't have to pay any taxes on that money anymore. So all the Facebook money he makes, no taxes whatsoever. He's a 1% owner of Facebook, right? In terms of his portion of his shares, but his foundation trust owns 99%, right? So we can set it up different ways, but basically, all you have to do is if you want to remove the cap, the 610, right? Maybe your income is $1 million each year. And you're like, man, I want to get rid of this cap, this 610 cap, and it goes up every year, but I want to remove the 610 cap. And we got to get rid of that W-2 income or reduce the W-2 income, find another source of income, like business income, set up through trust, your business trust, family trust, and then your foundation trust. And then you pay zero income taxes every single year for the rest of your life.
So regardless of a cost seg.
Right, exactly. I mean, we're going to
caps.
cost seg the life out of every property, no matter what, to offset some of that business income anyway. But there's always going to be something left over. And so the leftover, we put some of that into our family trust to pay for our personal expenses that we can't always write off on our taxes. And then what's left over after that, we put that, we park that into the foundation. And so basically, yeah, you literally have three vehicles going that allow you to never pay income taxes for the rest of your life.
Okay, so we do have a question. Okay, let's say you've got 25% bonus depreciation again, and then you've got a property for 5 years, and now you're talking about, you know, using maybe a third, give or take, of the depreciation that's available, lowers your cost basis, and then something happens and you want to sell. That's your question.
Yeah.
So then we talk about the strategy from there to be able to rinse and repeat. What's the solution
Is
there?
there a cost, you know, recap cost on that?
What's the
great
solution?
question. Yeah, my advice: never sell real estate. Never sell if you don't have to, right? Maybe There's only really two reasons why I think it would ever make sense to sell a property. Number one is that the property is not performing the best and you absolutely can't turn things around. You need another operator involved in it. So then you sell it at that point. Or number two, you just need the cash, right? You need the cash. You can't do an HELOC because of interest rates. Can't do a refinance because of interest rates, right? So to me, there's only really two reasons why it would, in my opinion, make sense to sell. You can ask the same question to folks like Grant Cardone and all of them, and you can ask them a question. Out of all the real estate that you've had, was it a smart decision for you to sell any of them? And they'll answer the question with a resounding no. It didn't, it wasn't a smart thing to do. But we understand things can happen. So if you are in a situation where you need to sell, then what you would do is you would first, before you find a buyer, you would first find a 1031 exchange intermediary and do a 1031 exchange so that you can trade that property for another property. My advice is if you're about to get out of a property, you got to buy something else, right? Unless it's, outside of it maybe being sold at a loss or anything, then you don't have to worry about taxes. You have a cash problem to worry about. But nonetheless, let's say, the property is profitable, you're going to make a profit, then you would do a 1031 exchange that allows you to trade one property for another or up to three properties at a higher purchase price than your current property. And that will eliminate the capital gains tax, right? The 20% federal, and then we got the 4% Obama tax, so 24% total. And then if you're in a state, right, depending on what state you're in, I know we're talking more so Florida today, so no state income taxes. So let's just cap it at 24%. To get rid of that 24% capital gains tax, basically you would do a 1031 exchange to trade one property for another. And you can do a cost seg on a new property because it's at a new purchase price. Basically, what would happen is the old purchase price would replace the new purchase price, or you would swap out purchase prices basically. And then you can do a study on what's left over on the difference in the purchase price.
Okay, so let's say I buy a property for $1 million.
Mhm.
I sell it for 1.5,
Okay.
and then I go buy another property for $2 million.
Mhm.
So that I'm taking that $1 million original price. I've got a cost basis in that versus the spread of what I sell it for.
That's
And where
right.
that spread is long term, I would take that spread, take that from the new purchase price of 2.5, and that would be the new cost basis.
Yeah, it's very complicated to calculate. Basically, long story short, we can just assume that it's the new purchase price because there's certain factors you got to put in there. As a matter of fact, in our firm, we have a whole calculator, a whole software that we use for that. But it's safe to assume that if you're buying a new property at 2.5, then basically the new cost basis is technically going to be the 2.5, but we got to knock off what you claimed in depreciation in the past from that price.
Okay. So I mean, if you buy property and you live 60 more years, at some point there's no dodging taxes, sort of.
Yeah, there is. If you buy it and you hold it,
You
Okay.
never
So-
sell it. Yeah.
Never said.
right, you never sell it. And here's the thing, you pass it on to your next generation. That next generation is actually going to get a bigger benefit, a bigger tax benefit than you did, because guess what? We get what we call stepped up cost basis, which you buy a property for $1 million, 60 years from now, it's worth 20 million. And that's like very conservative, right? So whoever that person is, get to take a tax deduction, do a cost seg. Let's say that, somebody's in the office and they do 25%, they allow 25%. Now we can do 20 million times 25%. Mind you, you've depreciated the bones, right down to the bones of this property. You've had this property for 60 years and you bought it for $1 million. You got a 150,000, let's call it tax deduction, to say it's in today's terms, you got $150,000 tax deduction. Well, when you pass it on to your beneficiaries, not only are you giving them cash flow, you're giving them a tax deduction that will be worth $5 million, assuming that the rate goes up to 25% at that point. So man, if they don't say a big thank you at your funeral, I don't know what's wrong.
All right, amazing stuff. We've had a few questions come through. I'm going to open up for more questions from the audience here. Anybody else have any
Yes,
questions?
I do. So let's.
Sorry, you're not allowed for any more questions.
Okay.
Shoot, Sean.
So if you have a property and you're depreciating over 27 and a half years, so it's 15 years into the cycle, and then you have another capital improvement, can you do cost segregation again?
Did you hear that part where
That's
you
great.
have capital improvement?
Yeah, that's a great question. So technically, I mean, you could do a cost seg on improvements, but you don't really need to. It's safe to assume that all the improvements that we do on a property, we can do bonus depreciation for it anyway. So the cost seg is really for the asset itself, the property, when you first buy it or when you first place it into service and do a cost seg for it. So when you do improvements to a property, we're just gonna flat out claim bonus depreciation on that. Right now, bonus depreciation is, and I don't mean to confuse anybody when I say certain percentages and certain numbers. Right now, it's at 60% of. So, for example, you buy a car, a Range Rover, you can claim 60% of the Range Rover's purchase price as a tax write-off, right? So, whatever repairs you do, you can claim up to 60% for 2024. And then the remaining 40% gets spread out over 5 years, or 15 years, basically, right? And so, some of these things are a bit complicated to explain. You sort of have to know like the ins and outs of everything. But basically, if we do improvements, we can claim bonus depreciation on those improvements no matter when you did them. Today, 10 years from now, 15 years from now, without needing to go through a cost segregation step.
Okay. So if you type into Google Jeff Badu, you're going to see his website. You're going to find other platforms, social media, Instagram, etc. So what's the best way to get a hold of you and ask questions?
Yeah, absolutely, Joe. First and foremost, I do want to thank you for allowing me to be on your platform today. It's definitely an honor and a blessing to be able to speak to a group of like-minded people. So thank you for that. Shout out to a few team members who are joining us today as well. We got William Champion, Celeste Williams. So definitely appreciate you all. But basically, to get in contact, my advice is visiting our firm's website. So badutaxservices.com. That's badutaxservices.com. And if you want to work with us, you simply either give us a call or you can fill out a quick 1-minute questionnaire, right? There's a questionnaire on the website, just 1 minute, just for us to get to better know you. And then we take it from there. If you want to call us, phone number 773-819-5675. That's 773-819-5675. But I would say the website, badutaxservices.com, BADU tax services with an S, .com. That's going to be the two best ways to reach out to us. And then if you want to get more on a personal website side, it's simply jeffbadu.com, JEFFBADU.com. And that allows you to just get more education, more information on some of these topics as well. Right?
Okay. In 4 minutes, infinite mindset, abundance. You got a couple books that you can find on your website. In 4 minutes, why write books like that? What's the power of that stuff? Tell me about that.
Yeah, so currently I have 4 books, and there's a 5th book that is set to be released later this year called No Excuses. But the number 1 book that I would recommend anybody read is this one right here. It's called Infinite Expansion. Infinite Expansion. It is available on Amazon. It talks about my life's purpose, right? So just to get to know me on a personal level, and the 12 steps to creating an abundant lifestyle, right? If somebody were to give you a blueprint of 12 steps so that you can create abundance for yourself, abundance for your family, and 1,000+ generations that come after you, then this would be a great book to just check out. Right? It's a purely mindset book. It's not directly tied to creating wealth or anything like that, but it's more mindset about creating abundance. Right? Wealth is great. Wealth is a part of abundance, but how do we create abundance for ourselves and the people around us? So I guarantee you that after reading this book, your mind is going to expand It's going to go to new levels, new heights, things that you didn't think you would be able to achieve. All of a sudden, it seems so realistic in your mind. And they say seeing is believing, believing is achieving. And so this book allows you to achieve more in life and to create abundance for yourself.
Okay, you've got another book that's tied to tapping into abundant resources.
Yes,
What's one resource that you've come across that you can tie solely to this type of abundance mindset?
I mean, honestly, I would say it's the people around me. Right, show me your friends, and I'll show you your future. You always want to surround yourself with great people, great coaches, great mentors. So that's definitely a big one. I mean, if I could point to one tangible resource, it is, a book like Rich Dad Poor Dad, Rich Dad Poor Dad, right? Reading that book completely expanded my mindset, completely expanded how I think about certain things, how I do certain things, certain beliefs, things of that nature. So Rich Dad Poor Dad is one resource that definitely helped excel my mindset to the next level. So if I could point to one tangible resource, it would be the book Rich Dad Poor Dad. Shout out to Robert Kiyosaki for such a great and amazing book.
Awesome. Well, Jeff, thank you so much for making time out of your busy schedule. It was a lot of fun, and hopefully everyone got something out of this hour-long discussion, and can't wait for the next one.
Amen to that. Like